Just now, Nilesh has been quite vocal, not from last 10 days, but last 2.5, 3 months, that look, this market is good. But in the short term, you have to understand that there is a way in which you value the markets, and there was perhaps a bit of euphoria which has kicked in. Nilesh bhai, good morning. Thank you for joining us. Markets sometimes find a reason to correct, and now currently there are plenty of factors. The Paytm IPO debacle, reversal in farm law, and Reliance has decided not to go ahead with its proposed demerger. Which, to your mind, is the dominant factor why markets are correcting? And has the market lost its near-term inertia? Has the train stopped on the platform now?
So, Nikunj bhai, I think the simple reason why markets are correcting is because prices had run up little bit ahead of fundamentals. And yes, train has stopped and in fact taken a slightly reverse direction so that people who are standing on platform can board the train, can alight the train. There are many factors which have contributed to correction, but my feeling is that the primary reason is that market was running ahead of its fundamentals. It's taking a breather so that fundamentals can catch up.
When you see a reversal like Paytm, it reminds you of about what happens to Reliance Power. I know it's unfair for us to compare Paytm and Reliance Power, but the 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 sequence of event of what happened after Reliance Power, could that happen after Paytm, purely in terms of market positioning?
So Nikunj bhai, we are not allowed to talk stock specific, but I don't think so. IPO market is dead. We have seen yesterday one IPO getting closed. It almost scored a century plus. And this is despite the fact that previous IPOs money have not yet arrived. There are many more IPOs in the pipeline. And my feeling is that the primary market response will be still positive. It won't go into slumber like in 2008. Compared to 2008, 2021 is slightly different. In 2008, valuation was across almost bulk of the market, and very few part of the markets were looking reasonable. I remember in 2008, entire pharma sector's market cap was comparable to just a couple of infrastructure companies. This time in 2021, yes, there is a red zone. There are some limited floating stock, concentrated holdings companies where valuations are sky high. But in bulk of the market, valuations are fairly priced. And with this correction, they will become attractive. So compared to 2008 kind of slumber, I don't think so. In 2021, we will see either in primary market or secondary market that kind of correction.
Right. So my next question is, what is next? Will budget be the next trigger? Will earnings season be the next trigger? What is that one big trigger which now we need to look forward to so that market can generate fresh inertia or momentum?
So there will be a couple of triggers from global side and obviously many more triggers from the local side. Globally, market is watching FOMC movement. Yesterday, US markets went up thanks to renomination of Jeremy Powell as Fed chairman. There will be continuity in Fed. Now, people will be looking forward to what is his guidance on the likely increase in US Fed rates and also whether taper tantrum amount will be increased or not. The second thing will be what kind of steps are taken by China, and will people try to take China plus one, not only in terms of foreign direct investment, but also in terms of foreign portfolio investment. The third could be global oil prices as well as COVID-19 situation. And in some sense, oil prices have corrected once COVID-19 cases started surging. So what happens over there also will have an impact on our market. But these are all transitory factors. They impact our market temporarily. What impacts our market long term is how our corporates are performing And certainly investors will be looking to the budget. Hopefully, they will be looking forward to a budget like last year, which kind of accelerated growth in the economy, which pushed reforms and which improved tax compliance. So budget could also be a trigger. December quarter results also could be a trigger. If they are as good as September 21 quarterly results, then certainly there is a limited downside in the market.
Nilesh Shah, good morning. Nayantara here. Since you're talking about the union budget, the speech that will be presented on 1st February, let me ask you a question that was being discussed yesterday. The move by the Prime Minister over the weekend on Gurpurab, repealing the farm laws. The markets are not concerned that will this impact the reform measures going forward? Uttar Pradesh is the size of 7 countries. All roads to New Delhi go from Lucknow, as they say.
Undoubtedly, people will be watching developments. Farm laws were really good for India's agriculture sector. It would have supported higher contribution from agriculture sector. But we are a democratic country, and here we have to build consensus and then move forward. Fortunately for listed corporates, agriculture is not that big a play. And rural India is not entirely dependent upon agriculture. Now, agriculture contributes less than half of rural GDP. So markets will be undoubtedly looking forward to other reform measures like divestment, or in terms of what is the fiscal space which government today enjoys. How are they going to spend money on it? So yes, there is a disappointment on repeal of farm laws, but that's not necessarily the reversal of reform process. Continuation of divestment, spending or using fiscal space for boosting infrastructure, that also will support the market.
Okay, so let's see if the momentum of reforms also continues. We have no reason otherwise to believe. Remember, it's the same government that is privatizing Air India as well. Nilesh Shah, when you were talking about the global cues and responding to Nikunj's question on the Fed chairperson, we didn't talk about the US dollar index that much. Is that also a concern at the moment? Can it, the way it's moving, can it prompt outflows? Is it going to come at the risk of an outperformer like India?
So we'll have to actually see how foreign portfolio investors react to it. As of today, there has been some amount of selling in the month of November, but there is a fair amount of active interest in primary market. The data reported only includes secondary market sell. It does not include primary market investments. If I include both primary and secondary, then outflow is fairly marginal. It's not material. Second, we are also now sitting on $640 billion reserves. We are one of the few countries in the world where FX reserves are more than FX debt. And hence, taper tantrum will not have that kind of impact in Indian market as it had in 2013.
Sure. The other aspect, of course, Nilesh, is also the fact, like you also have been highlighting for a while now, that India is actually one of the few countries in the world wherein the interest rates are still positive, the real interest rates, that is. Just wanted to understand, while up until now, RBI has been very supportive of growth, inflation is pretty much under control. When is it that we can see a change in stance perhaps by the central bank? Because that is something that the market is sure going to react to going forward.
So in a very lighter way, RBI is betting like Rohit Sharma and Virat Kohli together, bowling like Jasprit Bumrah and Mohammad Shami together, and fielding like Ravindra Jadeja. Now, you really can't expect more than this from Reserve Bank of India. They have been managing growth, inflation, interest rate, government's borrowing program, massive inflows from foreign exchange market, and fair value of rupee. Till now, in last 18 months, as I mentioned earlier, they have done an exceptionally brilliant job. And today we are, in a position where Indian inflation is actually lower than US inflation. Now, when people say we are in a high inflation country, I mean, I wonder what are they going to comment about US? I never hear them complaining in US that US inflation is higher. There they are supportive of Fed. Here they are saying that inflation is out of control. I think we need to trust RBI. They have been managing excellent balance between growth and inflation. I'm sure they will change the gear at the right time to ensure that growth also gets supported and inflation doesn't go out of control.
Sure, interesting point there. The other thing that I wanted to talk about, Nilesh, was you were earlier alluding to Nikunj's question, saying that the market train has sort of paused for those waiting on the platform to jump in. The point, of course, is what compartment do you actually hop on to? Is it more of the same? Are the same stocks and sectors going to move up for as long as this market decline lasts? Or do you think the market texture, when the selling abates, is going to change a little bit?
So while broad markets have not corrected as much, individual stocks have corrected significantly. And there are some great opportunities emerging in some of those stocks. So if I have to divide on a broad basis, there is a red zone in the market where I still believe there will be bigger price correction. This is, stocks which are penny stocks where there is no business fundamentals, but thanks to social media push, prices had run up significantly and distribution was happening. These are all those limited floating stock concentrated holdings companies where valuations are sky high. Avoid this red zone even at this point of time. Within the green zone, there are many stocks which have corrected reasonably well. They are now available below their historical valuations and where growth opportunity looks better. So avoid red zone, try to invest gradually into the green zone. If I look at from a sectoral point of view, we still believe capital goods, stroke industrials, home improvement, and select financial services will offer outperformance in the market apart from technology.
Why are financials not leading it from the front? For capital good companies to do well, they'll borrow capital. For economy to do well, it would need support of borrowing. But if I look at what banks have done in terms of performance, they've not been the leaders. When you are in economic upturn, you would imagine that banks should be the leaders. They are not the laggards, but they are not the leaders. Why is that?
So Nikunj, there are a couple of factors coming into play over here. One is this whole disruption being caused by fintechs. Now, fintechs are getting access to capital. They are able to disrupt things. And, there is a model where on the top of a bank, there is a fintech company which is luring customers. And they are able to lure customers because of their architecture, because of their technology platform, because of their ability to reach out to customers and retain customers. Now, market is keenly watching. Will bank remain in the business of lending and borrowing, or will they end up giving up control of their customers to such kind of fintechs? So this is one broad play. And over here, Nikunjbhai, I believe banks which are reinventing themselves, which are creating this kind of neo banks within their bank, they will do well. Not all banks have similar kind of technology platforms or customer retention power. A bank which will be able to sell many more products to their customer through technology will continue to do well. The boys will be separated from the men's. The second thing related to banking sector is the credit growth. Credit growth has remained subdued as many companies have deleveraged themselves. We are waiting for start of the capex cycle where company starts borrowing money from banks, and that will happen probably over next 2 or 3 quarters. As credit growth number starts improving, we will see banks outperforming. Now here also men's will be separated from boys. Not all banks have ability to evaluate credit appropriately. There are some banks which are taking higher credit risk and hence will generate future NPAs. There are some banks which will know how to manage credit risk and hence they will do well. So between fintech and credit growth, I think there will be winners within the banking system. And that's why I mentioned select financial services firm.
Okay, so maybe that is why we are not seeing a change in leadership. IT still at numero uno. It's always a pleasure talking to you. Thank you so much, Nilesh, for joining us today live on the market.